Welcome back. Thanks everyone for joining us for another Business Legacy Summit. I'm Troy Knorr, the Executive Director and Managing Shareholder with Boulevard Wealth Management. I'm here with Neil Rohrs, who is with with Platinum Bank. Great to have you back, Neil.
Likewise, Troy. Kind of getting right into it. Seems like everyone's, every time we kind of have one of these sessions, there's some new headlines grabbing the attention. Clients have been asking kind of whether we should be worried, whether there should be making changes, or whether there should be doing something completely different. So looking forward to hearing what you kind of have to say about these, what's going on locally, lately here, and kind of break down what's been happening over this last couple of weeks.
Yeah, absolutely. Well, it's certainly been an eventful stretch here, Neil. But I think it's helpful to start with a little perspective. So I'm going to share a chart of the S&P 500 just to kind of give you an idea of where we've been. So when we last recorded, right, the market had just come through this 9% drawdown, right? And that was off of a high on February 2nd, just shy of 7,000, right? So at that point in time, valuations were relatively stretched. We were trading at about 23 times earnings, which is very expensive, right, in historical terms. And so whenever markets have that kind of valuation, one of two things have to happen. Either price has to come down to rationalize it, or earnings has to come up to justify it, right? And that's exactly what happened. The market was already at elevated levels, so it was looking for an excuse to kind of level set, if you will. So, and that excuse was provided through the escalating geopolitical tensions in the Middle East. So you can see we had this 9% drawdown, right, from the beginning, basically the end of February through March 30th, right? What's amazing about that is that it was only 9%, right? And we kind of meandered down. And we came down to 19.7 on the S&P 500. Long-term average is about 19.8. So we kind of really just rationalized there, right? So that shows how resilient the market really is.
So it's kind of important distinction because so many investors are assuming the headlines were causing everything. In all reality, the market had already priced kind of for perfection.
Yep, exactly. So one of the biggest misconceptions that every correction means there's something fundamentally broken, but it doesn't mean that. Historically, corrections of 10% or more happen 2 out of 3 calendar years, right? So in fact, I would argue, as I already said, it demonstrated remarkable resilience to only go down 9% with all that geopolitical tension. So once negotiations started in the Middle East, you can see we started to come back up. This tick up there, that was the ceasefire, right? And so once some clarity started to come back into the system, you can see we started to move back up. And what's even more amazing is one of the key technicals that we track is this green line. That's the 10-day exponential moving average. So you can see all the way along, we were coming down to the 10-day, touching it and bouncing back up. So what that tells us is that institutional investors were using every little short-term dip as a buying opportunity. That really supports our bullish stance until we got into June, and then geopolitical tensions escalated at that point again.
So underneath all the headlines, buyers never really disappear.
Yeah, that's right, right? We rallied more than 20% from March, almost, not nearly. It's 19 and a half, right? I'm a geek, so I'm going to be precise,
Yeah.
right? So from March 30th through the beginning of June, we were up almost 20%, right? And then as tensions came, started to escalate again, we had a drawdown of about 5% again, right? But what amazes me about that, Neil, is we came right down to the 50-day exponential moving average. So that's another confirmation of trend. Buyers stepped in and confirmed that as another entry point and confirmed the bullish trend in the market. That's another constructive technical signal. So today we're trading well above those March lows and the momentum indicators that we could experience a modest pause, but the broader trend continues to look healthy. Now, does that mean we're going to simply sit back and do nothing? Absolutely not, right? Our principles we've always followed is taking profits when the opportunity presents themselves, right? So risk is not what we already know, it's the unknown. So there's always another headline that's coming that we can't anticipate. So when portfolios have appreciated significantly, we want to harvest a portion of those gains and that simply represents prudent risk management.
That's something I find myself discussing with my clients, pretty regularly. Taking the profits isn't a bullish, a bearish call. It's simply portfolio management.
Correct, right? Exactly. We're not suggesting that investors abandon equity. We're simply recognizing that successful investing requires discipline. When markets reward you, it's perfectly appropriate to rebalance and prepare yourself for whatever comes next.
Earlier, Troy, you had mentioned kind of the valuations, and how they are out of whack. Where do they stand today compared to where they were earlier this year?
Yeah, they're actually in better shape, right? During the correction, multiples contracted to just under 20 times, right? I said 19.7 because I'm a chart financial analyst and I'm a geek. So I'll be down to the 10th, right? But we
Yeah.
contracted about 19.7 times. That, so that represented the market's, adjusting prices lower. And then what happened was something encouraging. Corporate earnings started to come in higher than expected, right? Instead of prices doing all the work, then earnings started to catch up. So it started to push that up. If you remember the chart, we were at 23 times February 2nd, right? And right now we're trading at about 75.43. So we're actually up, but the price to earnings ratio is right about 20, which is right above long-term, like 20-year averages. So I'm perfectly comfortable with valuations at this level.
Okay. Especially consider the technology investments taking place today.
Yeah, exactly. Whenever there's something transformational coming through the economy, like the internet revolution, like artificial intelligence, markets can often support higher valuations. Like, during the 1990s, as I said, was the internet. Today, it's artificial intelligence. There's a difference. The difference is in the underlying business models, right? So during the internet revolution, it was primarily advertising revenue. We were selling eyeballs, right? And so what we know is during an economic downturn, right? One of the first things that is cut is ad revenue, right? And so
Yes.
today AI companies are increasingly relying on a subscription-based model. It's a recurring revenue, monthly subscription, and it produces more predictive cash flow, right? So that's a healthier business model. Could we eventually overbuild AI infrastructure? Absolutely. That is a legitimate risk. But the foundational supporting today's investment cycle appears considerably stronger than it was 25 years ago.
Okay. Well, one question I'm hearing regularly from business owners is kind of concerns about AI employment. And there's no doubt about it. Companies like Microsoft are continuing to announce layoffs. And some clients are kind of wondering whether we're heading toward widespread job displacement. Kind of how do you see that shaping up, Troy?
Yeah, I think reality is considerably more balanced than the headlines suggest, right? Yes, some companies have eliminated positions because of AI, but we've simultaneously created more jobs in the broader economy. The net impact hasn't matched the dramatic predictions, right? The second point many people overlook is costs, right? So AI isn't free, it has a cost, right? So people try the model out, they see how it works, and then as they commit to it, they've got increasing costs with respect to subscriptions, right? They've got implementation expenses, they've got cybersecurity requirements, and integration challenges. So eventually management starts to compare those costs against employing talented employees, right? It's not always obvious that replacing employees generates meaningful savings. In fact, we're beginning to see companies that aggressively reduce staff, started rebuilding portions of their teams because the implementation didn't deliver everything that they had expected.
Okay. And that's consistent with some conversations I've been having. It's like many business owners are kind of viewing AI as another productivity tool rather than actually replacing experienced workers, basically trying to get more out of them.
Yep, absolutely. I agree. And there's another important demographic trend. Economic growth comes from two primary sources: growth in the labor force and productivity gains. Our working age population simply isn't growing the way it did decades ago. As baby boomers retire, there are not enough younger workers entering the labor force to replace them. That's one of the reasons productivity becomes so important. Rather than viewing AI as replacing millions of workers, I think it's more accurate to say that AI helps offset a slowing labor growth rate, right? That's much healthier long-term narrative.
Yes, I agree with that. Beyond valuations, earnings have also surprised investors.
Yep, they really have. At the beginning of the year, analysts expected approximately a 15% growth rate in earnings for the S&P 500. As we closed the first quarter, that got upgraded to 17% earnings growth for the year. And today we're approaching 24%. That's an enormous upward revision. Remember, stock prices ultimately follow earnings, right? So if companies continue to generate stronger profits, higher stock prices become easier to justify. Will earnings ultimately reach 24%? Maybe not, because as forecasts evolve. But even if we finish somewhere below those expectations, I still believe returns in the mid-teens are entirely possible this year. But that won't happen in a straight line, Neil, right? We'll experience, we'll experience volatility, we'll get some setbacks, but overall outlook remains constructive. We're managing risk rather than preparing for a bear market.
So investors shouldn't be confuse normal volatility with deteriorating fundamentals.
Exactly. They're two very different things. The fundamentals continue to support higher equity prices over the intermediate term, but that doesn't eliminate volatility. It simply gives us confidence that temporary pullbacks are likely opportunities rather than reason for panic.
Sounds great. When we come back for part two, I'd like to shift from the corporate earnings to the broader economy. I'd like to kind of get your thoughts a little bit on like inflation, kind of the new Federal Reserve policy we got kind of in process, some of the recession probabilities, and I'd like to spend some time discussing how that kind of means to investors and how today's interest rate environment is creating opportunities we really haven't actually seen in a lot of years.
Yeah, that sounds great, Neil. That's a lot to unpack, and I think it'll be a valuable
Yes.
discussion for our listeners. So we'll see you next time on Business Legacy Summits.